Ladies and gentlemen, good day and welcome to the BlackBox Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjeev Verma, Whole-Time Director and CEO of BlackBox Limited. Thank you, and over to you, sir.
Thank you. Hello and good morning, everyone. I hope all of you are keeping safe and healthy. On behalf of BlackBox Limited, I welcome everyone to our Q4 and FY23 earnings call. On the call, I'm joined by Deepak Bansal, Executive Director and Global CFO, and SGA, our Investor Advisors. We have uploaded our results presentation on the exchanges, and I hope everybody had an opportunity to go through the same. We're happy to meet again. I'll start with a brief overview on the quarter gone by, followed by business and financial performance for Q4 and FY23. BlackBox is a leading global ICT solution provider focused on designing, deploying, and managing digital infrastructure for our global enterprise customers and Fortune customers, including cloud providers. We are present in 35 countries and supported by 4,000 plus highly skilled resources. With our expertise, businesses can create and offer relevant technological solutions and services that support their core business objectives. Our strategy of global, that is think global and act local, helps us keep our relationships local and at the same time be relevant with providing the flexibility to our customers to cost-effectively deliver in 35 countries, including from our Center of Excellence in India. We have reported a robust performance in Q4 FY23 and won new project deals worth upward of $95 million during this quarter. This performance was achieved across our business areas, of which significant performance was seen in data centers, our 5G infrastructure, connected buildings, and digital workplace solutions. On a full year basis, we had new deal project wins in excess of $250 million, with a large order backlog for North America of over $209 million as of March 23, compared to $148 million in March 22 and $87 million in March 21. With consistent growth in order book, despite the difficult economic environment, is a testimony of the strength of our business model, and we're optimistic that we'll continue to see the same momentum in the coming quarters. It has been a challenging year for the corporates in terms of overall operating environment. The margins were impacted by inflationary cost pressures and supply chain challenges. However, we did take some important decisions, which Deepak will talk about shortly, that allowed us to deliver improvement in margin on sequential basis over the last couple of quarters. On the revenue front, strong inflow of orders and strong execution has allowed us to deliver a sustained uptrend in our revenues. Our focus and investment in the data center space has been highly accretive. The market for data center, especially with the hyperscalers and cloud providers, is expected to grow significantly over the next few years, and we are well poised to address the opportunity that lies ahead of us. We currently count 3 out of the 5 hyperscaler cloud social media companies as our customers, and are happy to state that we are well on our way to add a second $100 million customer account in this space, with significant project wins from largest social media giant in fiscal 23. We're always looking out for good acquisition opportunities. Our key thought process behind any acquisition is A, to identify businesses that provide expansion to scale and revenues currently operating with suboptimal margin profile. B, it has to be complementary to our existing business in terms that it allows us to acquire newer customers, scale up existing business, help to diversify to newer geographic locations, and build new capabilities. Lastly, we transform these acquired businesses quickly and bring out short-term synergy. Recently, we signed a definitive agreement to acquire Global Speech Networks Pty in Australia for a total consideration of Australian $2.5 million, which is subject to working capital adjustment at closing. The company is engaged in the business of providing design, configuration, implementation, integration, and ongoing service and support for the GSM Genesis Engage and Cloud Contact Center solutions. For FY22, it had total revenues of Australian $9.87 million. The acquisition will help BlackBox to strengthen its presence in Australia and also add Genesis capability to its services in ANZ region. This will also give rise to an opportunity to cross-sell to the current customers. For the last couple of years, we have spent time towards creating the right platform for growth of the company, and we believe the company has arrived at an inflection point which will help us to deliver much stronger profitability numbers from here on. Keeping this in mind, for FY24, we expect our revenues to grow in the range of INR 7,000 to 7,500 crore, with EBITDA of INR 400 to 450 crores and PAT of INR 140 175 crores. This is led by increasing our existing customer base, market penetration, plus addition of new clients. In addition to these inorganic opportunities and better optimizing our operational cost and efficiencies will help us meet our targets. That's it from my side. I now hand over the call to Deepak to run through the financial highlights.
Thank you, Sanjeev, for the detailed overview. Good morning, everybody. I will now discuss our financial performance for Q4 and financial year 2023. We are happy to report revenue growth of 17% year-on-year for FY23 and close the year with total revenues of 6,288 crores. For the quarter gone by, that is Q4 of FY23, the revenue increased to INR 1,682 crores, which is a growth of 17% as compared to Q4 of FY22. The growth in revenue is on account of a strong order book reflected in new order wins each quarter and larger share of wallet from our existing customers. Quarter over quarter, we are seeing good growth, and given our sales pipeline, we are confident of continuing the same growth momentum in the coming quarters. EBITDA for FY23 stood at INR 269 crores versus INR 260 crores in FY22. On a year-on-year basis, the growth remained stagnant and saw some pressure due to inflationary environment, supply chain challenges, and project delays. However, sequentially, we have seen a good uptrend in EBITDA, which increased to INR 95 crores in Q4 FY23 as compared to INR 73 crores in Q3 of FY23 and INR 80 crores in Q4 of FY22. Please note that the EBITDA for FY23 and the Q4 of FY23 excludes gain on cash flow hedges to the tune of around 20 crores. We are happy to see that our focus on cost rationalization initiatives and improved productivity have started yielding positive results. EBITDA margins for Q4 of FY23 increased to 5.6% as compared to 4.3% in Q3 of FY23 and 3.2% in Q2 of FY23. We expect this improvement trend in EBITDA margins to continue throughout FY24. Profit after tax for Q4 of FY23 saw significant improvement on a sequential basis. We reported a robust growth with a PAT of INR 23 crores for Q4 of FY23, which is a growth of 47% year-on-year and 197% on a quarter-on-quarter basis. However, PAT for FY23 stood at INR 29 crores versus 86 crores in FY22. PAT was impacted by higher interest costs and severance payouts to improve our onshore-offshore ratio. We foresee the severance cost to normalize and deliver a much stronger PAT in FY24. Sanjeev has already mentioned that we are targeting a profit after tax in the range of 140 to 175 crores for FY24. Going ahead, we remain committed towards improving our operating profitability, and some of the key drivers to drive the operating profitability would be A, customer operations and shared services utilizing our Center of Excellence in Bangalore. B, better rookie mix. C, better procurement and subcontractor management. D, right shore to ensure cost optimization. E, facility optimization and ERP consolidation. And repricing contracts to get better yields. That's all from my side. I will now leave the floor open for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and one. Our first question comes from Hiral Nandu with Kalpvruksh Capital. Please go ahead.
Hello. Hello.
Hiral, please go ahead.
Yeah. Hi. I have a couple of questions to understand. I'm new to the company, and just to understand on the number perspective and what I have heard correct to just clarify. We said that we are looking at a profit after tax of financial year 24 at around 140 to 175 versus what currently we are looking at like 25-30 crore. Is that means what I heard correct?
Yes.
Okay, great. So just a correlation with that, what order book we have and what revenue visibility we have for the year 24?
I think earlier call, if you heard, I think we have a revenue visibility of 7,000 crores. I think we're guiding at 7,000, 7,500 crores.
Okay.
Our order book, if I heard earlier, a new order book, project order book, stands about $209 million just for the US. There's been the highest ever. It's about 3 times more than what we used to have in fiscal 21. So therefore, I think our revenue guidance, we are confident of the range of 7,000 to 7,500 crores.
Great. And the margin improvement will be with the increase in the revenue and the other costs remaining more or less stable, or any other factor that we will be having some saving on the revenue, maybe some interest reduction cost and some other reductions in the cost?
So on the margin, yes. Go ahead.
Yeah. So on the margin improvement and the PAT margin and the EBITDA margin improvement side, just to understand that how it will improve from the current level and what could be the approx range at with 140 or 175 crore odd, what would be the approx PAT margin percentage?
Yeah, so we are taking a the baseline exiting of a quarter 4. If you heard Deepak call out, right, about 95 crores of EBITDA and at about 29 crores ballpark of PAT. I think we're baselining that exiting. We expect to improve from there. So therefore, we are looking at more positive about the higher end of the guidance and not the lower end of the guidance. More towards 450 of EBITDA and more about 175 of PAT. And if you look at our baseline for quarter 4, we are at or about the lower end of the guidance already. We expect that to improve. The improvement will come from, one, of course, partly from growth. Some of our costs are fixed. So therefore, when you go from 6,300 to 7,000, the costs will not grow in a linear fashion. So there's more drop, of the gross margin at the operating income level. So that's one. Second, of course, you had Deepak call out of certain more efficiencies of using our right onshore offshore mix. So we'll do that. So I think a mix of that and where we stand today, exiting quarter four, we feel confident about the guidance on all three parameters from a revenue standpoint, from an EBITDA standpoint, and from a PAT standpoint. And although we have been a little conservative, I think we are positive towards the higher end of the guidance and not the lower end of the guidance.
Okay. Great. Some light on key customer base and the revenue from, say, top 5 customer kind of just guidance. So who are our top 5 customers and what would be the revenue approximately contribution from them?
Deepak, you want to take that?
Yeah. So our top 5 customers include almost like Fortune 50 type of customers, in fact, top 10 customers. Top 10 customers contributes close to around 42% of our revenues in FY23. If you can look at slide number 11 on our investor presentation, we have a lot of details in terms of the client concentration revenue also. But the most important thing is that among the top 5 customers now, I think the largest, the top 2 customers will be crossing close to around $100 million each. So that they are part of the top 10, which is almost like 42% of our revenues.
Okay. Great. Thank you for that clarification and all the best. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from Ashay Jain with Jain Capital. Please go ahead.
Hi. So couple of questions from my side. Firstly, so can you talk a bit more about the recent acquisition announcement that we made, Global Speech Networks? Like what business do they do, and can it be a meaningful contributor to our sales going forward?
Thanks, Ashay. Yes, I think we have made a small acquisition largely in our customer experience contact center space. Earlier on, as you know, most of the contact center was on-prem. It is moving towards cloud. One of our initiatives in certain segments of our business is to what I call cloudify, so as we can go from the cloud. So GSN brings in that expertise, most specifically in the customer experience, customer service space, brings in a stronger partnership of the Genesis platform among the top 3 technology platforms in that space, and we expect that to be accretive for us. We will gain a certain set of customers in a very advanced market like Australia, and it will also enhance our capability on the contact center customer experience space, which is one of our business pillars, to help us take it to other markets as well. So to answer your question, yes, we believe it to be accretive. We believe it to be a future-facing, going in the right direction of serving a customer to the subscription cloud model, and GSN allows us to do that.
Just to add on to this question, can you also throw some light on some other inorganic growth opportunities that we are looking at?
Okay, so I think we continue to look at other opportunities. There's no specific comments or details I have for you on this call. But having said that, as I mentioned before, we are focused on the economics of the transaction. We will not focus on the emotions or the ego of the transaction. So therefore, if it's accretive to us by adding capability or a practice line that we got from GSN, or opens up a new geography for us that we believe would be accretive, or gives us some scale in that space, we would do that. So we'll continue to be prudent but opportunistic to see that we are able to have any inorganic opportunity. We'll do that. But our focus, of course, for the management of the business and our sales are largely to drive organic growth. in the areas that we operate, and we are seeing very, very good pipeline, if you heard earlier on. A pipeline from newer projects over the last 3 years has tripled now. So we continue to focus on organic growth and continue to look at opportunity-based inorganic acquisitions, if you may.
Sure. So secondly, on the margin front, the margins have been on the uptrend sequentially over the quarters. So do we see this trend continuing going forward? And what additional steps are we planning to improve on this further?
Yes, we do expect that we will continue to sharply focus on our margins and costs going forward, both at the gross margin level, which is for managing our cost of delivery and getting quoting at the right sales price to most. And I think that's an ongoing journey that we'll continue to focus on. For improving our operating margins from here on, we'll continue to focus on the Deepak called earlier efficiencies and productivity. And last but not the least, there's certain margin flows down on scale, because once we grow another 10-15%, which we are confident of guiding at 7,000 to 7,500 crores, some of the costs are fixed and they would not be adding up. So therefore, we'll have accretive to our margin. So to answer your question, yes, we'll continue to focus on selling better, delivering better, and managing better our costs to improve our EBITDA and PAT margin.
Sure, sounds good. Yeah, that's all from my side. Thank you very much.
Thank you. A reminder, if you wish to ask a question, please press star and 1. Our next question comes from Anjana Shah with Shah Investments. Please go ahead.
Thank you for this opportunity, sir. Am I audible?
Yep. Yes, you are.
So a couple of questions from my end. So for FY23, we had a total exceptional item of around 52 crores. And we see that, approximately 26 crores is towards provision of severances which have been paid. So can you help me understand what exactly is the foreclosure of leases and what's the loss on derecognition of financial assets?
Yeah. So the severance is primarily on account of the people what we have removed in US and Europe, because we have continued our strategy in terms of identifying the areas where we can do some of the remote delivery work from India. So we have hired people in India, but we have removed the people. So for that, there is a severance which has happened. So that is the severance side of it. On the lease foreclosure, basically it's more like a overall relook at our real estate portfolio. So we have a lot of real estate on lease across the in United States as well as outside United States, in Europe, in APAC, and everywhere wherever we have the offices in 34 countries. So we continue to restructure that whole lease. So when we restructure the lease and any lease which is going out, but when you do a early release of the lease and all those things, we renegotiate the liability for the remaining lease period and all those things. So that goes into the foreclosure of leases type of amount, and that's why that amount is there. On the derecognition of some of the assets, so we have looked at our non-current assets and all those things portfolio, and we have derecognized almost like 10 crores of the asset on the present value of those assets, and that's why that became an exceptional item, because that's more like a one-time type of cost which has come in, which we are not expecting to come in the future.
Sure, sir. So another one from my end. In our past calls, we mentioned that to improve our onshore-offshore ratios, we took a hit of employee severances. So what has been the extent of this impact in Q4 FY23?
So in FY23, so most of these, let's say, severances has happened between Q3 and Q4, which is November of 2022 to March of 23. So you would have, and as a result of that, that is a part, the benefits are part of the gross margin improvement of what is happening on the overall basis. So if you see the quarter 3 of FY23, our gross margin was 25.5%, and in quarter 4, our gross margin improved to 27.8%. So this improvement of 2.3% primarily has come in the form of this manpower reduction we have done in US and Europe, which is replaced in India. And as we all know that India, we can replace the manpower at a low cost as compared to the cost in US and Europe.
Sure, sir. Sure. Thank you so much. That was it from my side.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from Jia Shah with Wealth Securities. Please go ahead.
Sir, can you share your outlook on the Indian IT industry? How do you see the demand from this geography, and what are the opportunities that you're currently focusing on?
Okay, I'll take that. Of course, the Indian story is strong. So therefore, the Indian even IT industry locally, of course, will see hypergrowth. Right? I think we're seeing a lot of infrastructure, roads, ports, airports, data centers be getting built. Having said that, I think from our perspective, I think India remains a fairly small market from a customer acquisition standpoint, largely at the back of the cash flow challenges we see in India. So as much as we expect to be growing, but in India we'll be wanting to grow only at a very, very disciplined manner, although there's hyper growth. So I think, and it is in line with how larger global IT companies operate. We see larger opportunities in the similar space in advanced markets like America and Europe and Australia and New Zealand, where we have the ability to get better margin and better cash flows. So to answer your question, India will definitely see hyper growth in the technology sector, which you would be reading and seeing investment in data center or networks or 5G that is coming through. But I think, so we would, from our perspective, we would be expecting growth in the Indian market as well, but we are not addressing a large segment of the market largely purchased by the government. We do not participate in those, and we do not intend to participate in those, at least for the near term. So although India will see growth, it is between 5 and 7% of our business is expected from India, and that ratio will continue. We don't expect that ratio to change.
Okay. And can you throw some light on the biggest challenges that you are currently facing?
Well, I think few of the biggest challenges that we were facing, we're coming out of it, was supply chain, cost of labor. I think those things are easing out for sure at this time, right? And I think the other challenges that, of course, we might be facing, and therefore we are conservative this time, is the higher interest costs throughout the world. I think that impacts our customers, and if it impacts our customers, possibly it impacts their ability to make a quick decision. Although we are not seeing any softness in our business or our pipeline, largely at the back of our business being non-discretionary. But having said that, we are cautious with what's going around in the U.S. with respect to buzz around recession, interest costs. So these are certain things that affect our customers, and if it affects our customers, of course, then it affects us. So therefore, we are watching that closely. Having said that, we believe a very large part of our business is non-discretionary. We are building digital infrastructure. You have to build that, and so therefore we don't see an immediate challenge, but we are cautious about it.
Okay, thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from Suhas Nayak with Krida Capital. Please go ahead.
Hi, thank you. Thanks for the opportunity. Congratulations on a good set of numbers. I have a couple of questions. One is about whether we have cleaned up the large part of the balance sheet, all the provisions have been made, or we are yet to make additional provisions going forward? That's the first question. Second question is on the margin front. We sound quite optimistic, and we are doing pretty well in terms of growth, and our outlook is good. Then why are we just maintaining the fourth quarter margins for the next full year? Ideally, the margins should have been much higher with cleanup, the operating leverage you talked about, and cost saving because of offshoring. All these put together, we should have had a much higher margins than what we are guiding for. What could be the reason? And the last question is on the interest cost. As to how do you see interest costs moving going forward? Thank you.
So, Deepak, if you can take the first and the third question, I'll
I will take
possibly
it.
address
You go ahead with margin, and then I will take the.
Yeah, okay. So I think it's a very good question. I think if you look at our exit margin rate, we are about sub 400 type in Q4. So if you heard me earlier, I think although I expect our margin to be more on the higher end of our guidance and on the lower end of the guidance in all the three parameters with revenue, EBITDA margin, and our PAT, right? So it's more towards that. And, so two ways to look at it. One, of course, as you heard earlier on, we are being a little conservative. Some of our customers might get impacted with respect to the overall recessionary trend, inflationary trend, and therefore might get have an impact on our aspirations. Therefore, it is a little conservative, if you may. We are confident of delivering, I think, the under-committing and over-delivering the environment. We do not want to over-commit and under-deliver.
Okay.
As I said, we expect our to achieve more on the higher band of our guidance than the lower band of our guidance.
Oh, okay. But what is actually this business is? What are the sustainable margins of this business?
Can you repeat that question?
What are the sustainable margins of this business? Like, can we work with, say, 3%, 4% net margins kind of business?
No, I think so. The margin element is a part of scale growth, and so the sustainable EBITDA margin for this business is in the range of 7, 8, 9%. The sustainable PAT margin, of course, is an element of, again, growth.
Yeah.
How much can we grow from here? So it will be disproportionate. If you see our Q numbers for last year and this year, and even the numbers for PAT for last year, this year, the forecasted, is disproportionate. So if we land up doing 7,500 and move to a billion or build more, which are planned for going forward, it's disproportionately accretive, right? So I think it's not. So we have to reach certain scale to do that. We have been working focused quarter after quarter after quarter, sequentially, one step at a time. We have had some challenges, some controllable, some uncontrollable costs in COVID. We are coming out of it, and we believe now that we have reached the inflection point from where we can only, be more predictable and have a better gradient for growth, revenue-wise, operating margin. And therefore, we believe the higher end of our guidance of what we quoted was 7,500 crores of revenue, 450 crores of EBITDA, or 140 to 175 of PAT is fairly reasonable and conservative, and we are focused on delivering that. We have not guided beyond that, but I believe our future is much brighter. So we'll talk about it when we get there. Deepak?
Yeah. Okay. So on the balance sheet, you asked that question. So we have, I think, the balance sheet which is much stronger than before with our current assets and current liabilities ratio. So after a long time, our current assets are higher than the current liability. So that ratio is now above 1 on the current asset to current liability. So from that perspective, we don't see, let's say, much challenge on the balance sheet side of it. But we continue to monitor strongly on a regular basis our balance sheet, and we continue to see that there should be no pressure on the balance sheet, and that we continue to do business on a let's say normal basis and all those things. So that is on the balance sheet side of it. On the interest cost, we are not expecting as such the reduction in the interest rates which has gone up in US in last, let's say, 6 to 9 months period. So where the interest cost has gone up by close to around 5% here. So with whatever right now the discussions in the US market, including the debt ceiling and including the new paper of the Treasury, which is being discussed to issue between $500 billion to a $1 trillion, the whole discussion is towards that the interest rate is not coming down very, very nearly. In fact, now in the June meeting, there is a discussion happening that whether 25 bps increase Fed will do or Fed will do a put. If they put on not raising the interest rate, at least for 6 months there is no reduction. If at best the reduction happens by next year March or next year June, the reduction is expected between 25 and 50 bps. So at present, we are not looking at any reduction on the interest cost as such. We will maybe in the second half of the year, based on our EBITDA and based on our cash flow, we may repay some of the debt, so that some of the reduction will come. But otherwise, I think right now we are expecting it to continue at the same run rate of the quarter 4.
Okay. Great. Thank you very much. All the best.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from Akash Mehta with Capes Investments. Please go ahead.
Hi, sir. Good morning, and thanks for the opportunity. I had a couple of broader questions. In the presentation, we've maintained that to achieve our guidance for FY24, we'll be expanding our customer base plus penetrate in newer geographies. So just want to understand which new geographies are we intending to expand to, and which are the business segments that we look to start with?
Yes, I think some of the business segments that we expect to be highly accretive for us is our data center connectivity business, networking business, and our cybersecurity business. And all three are connected. And I think our growth, we expect massive investment in those areas. We are seeing it worldwide, both by the large cloud providers or even third-party data center build-outs, including in India. Some of the tie-ups for the data center is mammoth. Of course, we are largely focused in North American market. So we'll continue to go deeper in those businesses. I think we have reached a scale and an inflection point where our ability to participate in the bids or getting invited for larger bids, both local and global, has increased. So therefore, we expect to see more deal pipelines and deal closures going forward in the specific spaces of building 5G networks, a data center, and connected and smart buildings, which, of course, every other infrastructure is now smart and connected, right? So we expect that to happen, and our deal pipelines are very, very strong. The investment coming in that space is very, very strong. With respect to coming to newer geographies, I think we have a reasonable presence of geographies in 34 markets. We expect, again, to be able to build the relevant scale. Going forward, we want to build scale in the Asia-Pacific market, and we want to build scale in our European geography, right? And by addressing some of the larger economies in that market, we look at Europe, we expect to possibly do more in Germany. Currently, we are not. We are doing more in UK, to see that we are able to gain a certain growth or scale in those markets. Scale is important because a certain costs are fixed, so therefore you have to get into scale. Similarly, for Asia Pacific, with the acquisition of Global Speech Networks in Australia, we got both. We got certain scale, although it's a small asset, and of course we got a newer areas of cloud. So both from going deeper and wider with our existing clients, specifically in hyper-growth areas of infrastructure, data center, network, 5G, wired or wireless, as you can see, everything around us has to be rewired because we are so hungry for data that the existing networks throughout the world wouldn't sustain, and therefore you're seeing massive investments, and Blackbox is the forefront of doing that in each market we operate. And some of the markets that we're already present, if you need to go to geographies, we want to scale up, and Europe, Asia Pacific is what we are focused to scale up now.
All right, that elaborate answer actually helps. And Another question I had was on the customers. Basically, both the top customers and with Meta, we have started with a small base, which has a substantial revenue contribution for us. So can you just throw some light on the strategy of, how have we grown this account and what services do we give to Meta and what are the opportunities do we have for a cross-sell or an upsell here?
That was a good question. Yeah, so we started very small, just post Blackbox getting acquired. We are acquiring Blackbox in 2019, 2020. And of course, I think the opportunity was participating in their massive data center build-outs. As you know, Meta, Facebook, WhatsApp, Instagram are part of the same group, right? And they are consuming more data centers, than they can build. And we saw that opportunity, and I personally mentored that account as an executive sponsor from Blackbox, visiting their leaders very often and sitting in quarterly reviews. So currently, we are providing physical network infrastructure to Meta's data centers, both passive infrastructure, such as cabling, and active infrastructure with respect to building up their wireless and DAS network inside their campuses. We expect we had only one site over the period of the last 2-3 years' time. We are managing multiple sites in North America. We are managing a site in Europe. We are currently engaged in managing many more sites worldwide. So that's on the going deeper on what we do. Going wider, we expect to sell or to participate in other areas of Meta's technology purchases, and it could be their command centers, their audio-video requirements, their building management networks. So there are opportunities there as well. It's a large account. It cannot happen overnight, but we have a very focused team engaged with likes of Meta locally and globally. And we have grown the pipeline from a few $1 million 3 years back. We expect it to add up to close to $100 million as we speak. And similarly, from a top customer perspective, we're also working with other cloud providers in that space, the top 5. We currently are small with them, doing a few $1 million worth of projects locally, but we are focused on building the third customer in that space, getting it $100 million, right? So that, and we have created our teams and practices around building those focused approaches with our large customers. We serve many of the top banks. We serve these large cloud providers. We serve very, very large pharma companies. So we have a good spread of accounts that has the requirement for what we provide as a solutions, and we are seeing how do we increase that share of wallet, increase that heat map in every account by a very sharp, focused account management, good executive sponsorship, bringing capability, and I think those are the areas, those are the strategies that we are deploying to see that we are able to gain scale and more share of wallet from some of our top customers, both in North America and other parts of the world.
Okay, so I think that helps a lot. It answers my follow-up question as well, that, I wanted to know if there were any more customers that we were targeting for a US $100 million account. So thanks a lot.
Thank you. A reminder, if you wish to ask a question, please press star and 1. Our next question comes from Suhas Nayak with Krida Capital. Please go ahead.
Thank you for this. Could you comment on the one on the pipeline, how strong the pipeline is? And secondly, in terms of overall business environment, how are things looking actually in terms of, say, next 6 to 9 months? Thanks.
Thanks, Suhas. Okay, so from a pipeline perspective, and I alluded a few times before, our pipeline has been stronger than ever before. I think we exited last year, fiscal 23, or you can say we entered this year with the strongest project pipeline, in the history of the company, right? A new project pipeline. Of course, we have 3-4 lines of business. We get new projects, we have maintenance contracts, we have annuity, but newer projects that drive growth. I think our pipelines are very, very strong at this time, well covered, and we expect that to further grow at the back of our current talent management, some of the new leadership hires that we have done, more specifically in the focused areas of data center build-outs, networking with wired, wireless, and 5G, and of course, cybersecurity that we incubated 2-3 years back is coming up to scale, and we're winning some very, very good deals, combined deals with the network, with the infrastructure, and cybersecurity. So I think overall, the pipeline is very, very healthy, both in North America and in the rest of the world. We expect that to grow with more announcements of the data center capacity. So that to give you an example, in the United States, is currently consumed 97%. So there's no capacity, right? So, and they can't build faster enough. Right? And of course, with more and more people talking about connected cars, connected buildings, connected homes, this all requires digital highway, because if you have so much connected, you have to go from point A to point B. BlackBox is in the business of building that digital highway. So we expect more pipelines to come, and the more we scale, we are able to participate bigger. So I think we are very, very strongly focused on pipeline, very good pipeline, and therefore we expect to be able to harness that as we move forward.
You have already built good referrals with the names like Meta. How easy is it for us to now take this whole business to a new level where large marquee accounts like Meta join us?
Good question. So yes, of course, I think you get a seat on the table. You're part of a club that you can serve those customers. So we are currently focused on, we already have businesses with other similar cloud providers, largest e-commerce company in the world, the largest tech company in the world. So we are doing business, and the current focus is to how do we grow that $5-10 million annual business to into 20, 30, 40, 50, 60, $100 million business we heard earlier. So I think it's earlier on, I think if you heard Deepak call out, we had $100 million club customers. We're at the verge of the second one, focus on the third one. It's a journey, right? So I think, and you do not get into, you have to grow with that customer. You just can't go and just build that. So we feel very confident, and that with the reference that we have, with the work that we have done, with what we have learned over the last 2-3 years, there are very few companies in the world that have the global scale to work with such companies. BlackBox happens to be one of them. So I feel confident. Over the next 6-9 months, as you asked for, what do we see? I think I see beyond that as well, right? But I think we are pretty well covered and confident of the deal pipelines growing even more over the next 6-9 months.
Thank you. Thank
you. Our next question comes from Rajvi Shah with Shah Financial Advisory. Please go ahead.
Thank you for the opportunity. I just had a couple of questions. The first one is, what are your key growth drivers in the medium to long run?
Okay, so anything I've talked about, my key growth levers, if you look at in two aspects, we are looking at from a business line perspective, our infrastructure, data center, networking, and cyber. We expect that. And from a geographical presence, I think we are subscale in some markets. We want to grow in those markets, Asia Pacific and Europe, focusing on these three key areas, which is seeing hyper growth, networking, data center, and cybersecurity.
Okay. And my last question is, at the moment, what are your top strategic objectives for us?
Can you repeat that question, ma'am? Could you repeat that question?
Sorry?
Can you repeat that question? I didn't get that question.
Yeah, sure. At the moment, what are your top strategic objectives for us?
Top strategic objectives. Thank you.
Yeah.
Oh, okay. Yeah, I think, of course, the top strategic objective, of course, from our perspective is to be a dominant global digital infrastructure player. The second objective is to continue to grow over market, 15-20% organically. And the third, of course, is to provide a deep shareholder value by providing a stronger operating income and deep shareholder value. And it will come through our objectives of consistent, predictable growth as a company. We are a strong provider of digital network infrastructure, and I think we see hyper growth in that space, and I think that's our objective.
Rajveer, do you have any more questions for the management? We move on to our next question, which is from the line of Ashay Jain with Jain Capital. Please go ahead.
Yeah, hi. Thanks for allowing me again. A few questions. Firstly, like in the FY23, we've seen layoffs happening across the IT sector. So how is the demand environment now, and how do you see it in FY24?
I think we are focused on, as I said, building a digital infrastructure for tomorrow. And in a space, I see our line of business largely non-discretionary. If you landed up in a situation where you ran out of milk and ran out of the internet at your house, most likely you'll start to fix the internet first, and the milk can come later, right? So therefore, we believe that we build that. So we're not seeing this time. Not to say that things can't change, but I think our pipeline, our requirements, the capacity in the space of what we operate overall suggests that we have a very, very strong headroom over the next few years' time in building the digital infrastructure, network, data center, securing that infrastructure for our customers. So we see, we do not expect that. Having said that, I think we are also cautious. So therefore, that is reflective in our guidance. And I talked earlier of being a little conservative, although we are more focused towards higher end of our end of the band. We are being conservative at this time. We also want to invest, right, and in our business into newer capabilities, newer technologies, something that will keep us relevant and keep us future-proof and accelerate our customers' business. So therefore, those are also baked in our plans of investing in our new capabilities as we move forward, 5G being one of them, private LTE being the second one. We are very, very strong in that space in the U.S., and that is going to explode. As you must be at the back of IoT deployment that we're seeing, everything is connected. Our cars have cameras, our roads have cameras. Very soon, every other place will have cameras. So therefore, those need to be carried and processed somewhere. And that will require a different kind of a network. So we feel strongly about our opportunity over the next 3, 5, 7 years' time. A very, very strong pipeline order book in the short term that we have said. But I think we constantly keep our ears to the ground. We ought to invest in some newer areas to see that we remain relevant, so that we can harness the relationship that we have and therefore drive the results that our customers and our partners expect from us.
Sure. Secondly, like on this sequentially, we have seen good deal wins, and I believe in the data center segment contributed the most. So do you see this trend to continue in the coming quarters? And also, apart from data centers, which other business verticals is expected to see same growth going forward?
So to answer your first question, the answer is yes. We expect our deal pipeline from the data center business or the data center-led customers to continue. We have increased our focus. We have doubled down in that space. We have hired talent, hired management in that space. From local, we are getting global. And so that will continue in that space. The other few areas that I said before that we expect hyper growth are connected to data center. When you build a data center, you require the network. When you have the network, could be a wired or a wireless network. Now it could be a 5G or a private LTE network, right? Once you build the network, then you have to secure the network, right? Because as we all know, there's a lot of cyber going on, and our company is focused on doing that as well. So the areas of connected and smart buildings, which is a very generic term for intelligent buildings, which, as we all know, even our private homes are getting intelligent. So these are all connected. So data center, networking, wired or wireless, including now 5G and private LTE for the enterprise side, security, and anything that drives IoT in our connected building space. So I think all these are digital infrastructures, all these enabled to build a highway on which the future of tomorrow will run, right? You need to have a robust network at your house to be able to watch a Netflix. That's a content line somewhere. If you roll back 5 years back, and if you had that Netflix, you wouldn't be able to watch in your house because there's no internet to support that. Now you can, because people are bringing 1 gig at the houses. So just to give that reference, similarly, all corporates, all enterprise, countries, if you may, needs to be rewired for the new generation of AI and ChatGPT and ML coming in, because they have to travel over a digital highway. And that's what Blackbox is focused on, building those intelligent networks, infrastructure. And we believe that the next 3, 4, 5, 7 years, we'll see massive growth and explosion in rebuilding the network for tomorrow.
Sure, that's quite elaborative. So lastly, can you help me with the segment-wise revenue mix? Like, how do you expect it to evolve and shape up over the next 2, 3 years?
So I think, are you talking about the business segment? Are you talking about geographies or
business segments?
Business segment. Okay. So I think, I look at it in 2 parts, right? And I think if one, of course, we look from a business industry segment, we are largely agnostic to industry vertical. But having said that, not all verticals are the same, right? So although we have presence across manufacturing, banking and finance, and healthcare, we expect 2, 3 business verticals to be very strong for us. Banking and finance being one of them. Technology pretty much catching up, and it's called technology, that the likes of Meta and Amazon and Google and LinkedIn and Microsoft, or any other IT companies that the company serves. We also serve with many large technology companies. We use our skills in building their own infrastructure. Very, very strong for us. So I expect that either to be between the top 3, 4 for us. Healthcare. Blackbox is very, very strong in the healthcare space, so primarily in North America. We're expanding it to Europe at this time, which includes life sciences, the pharma companies. We're very, very strong pharma companies as well, who have large manufacturing R&D facilities. We support that with the lines that I said. So these are a few of the verticals that we are going to double down. With respect to our business segment or lines of business, I called out earlier, data center, networking, cybersecurity, and intelligent buildings, connected intelligent buildings, which encompasses all these 3, at the back of providing very strong services. So, right, we just don't deploy, we manage this for a long period of time. I talked about deal wins. Those are projects that finally turn into we design, deploy, and then start to manage. The new wins are for deployment, and once you complete, you go into management of that. So I think we see these business lines to be hyper growth. We have other lines which are more smaller but very highly accretive with respect to our collaboration workplace. CX I talked about, customer experience, which you roll back again, they require infrastructure to support, right? I mean, we are speaking today now over the phone, hundreds of people have joined, we could be on a video, that requires an infrastructure, right? So I think those are the focus segments, both on the industry side and our business side.
Understood. That's helpful. Yeah, that's all from my side. Thank you so much.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thanks. With this, I would like to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Deepak or our strategic growth advisors, our investor relations advisors. Thank you so much.
Thank you.
Thank you.
And everything. Yeah.
On behalf of Black Box Limited, that concludes this conference. Thank you for joining us, and now you may disconnect your lines.